Hi everyone, thank you for turning in. As you know, right, we have Sonal with us
Hi everyone.
to give you an insight about Indian equity market or an India as a whole. I am Mudit. I'm the founder of SBNRI. I think few of you would already know SBNRI, either have invested with us or have been exploring too. But SBNRI basically stands for investment and taxation. Anything, whatever you want to do in India, we stand by you, for you, and we would be always there for you in terms of any queries. And in line with that, we just wanted to give you a good sense of, we have heard a lot about India shining, India is growing, becoming a 5 trillion economy, 10 trillion economy. Completely agreed. I think all of us are absolutely positive about moving there. But I think what is important to know as individuals is how do we see what is the actual meaning of India shining, what sectors are performing, what sectors are not performing. And so we thought we would love to introduce our NRI users understanding about India. And so I got Sonal in, someone who I know for almost more than 5 years now, and have been a prolific person in investments. He in fact manages a lot of people who are in SBNRI. He actually manages a lot of portfolio of people within SBNRI and outside of it as well. So we trust the insights, the thought process a lot, and I thought it would be brilliant to hear it directly from Sonal as to what his journey was, how he finally landed up making a proper portfolio management company and then starting from it, and then probably focus on essentially what is it that makes us believe that India is shining, and essentially on ground what is working, what is not working. And I think we would take few pauses as I would ask him a few questions as he continues his presentation, and at the end we will take your queries as well if and when you would have queries, but finally we would take it at the end from our users, and in between I would be basically conversing with Sonal to give you a good clear picture. So over to Sonal. So to start with what we are here for. Yeah.
Thanks Mudit. So Mudit and I have known each other for almost 5-7 years now. He's been a great friend and a client for my fund Prescient Capital. So hi friends, I'm Sonal Minhas. I would run you through kind of a small deck. Just give me a second. I am bringing this swipe. Okay. Is the setup okay? Okay. Hi friends, this is Sonal Minhas. I co-run Prescient Capital. Prescient Capital is a SEBI registered portfolio management services that manages money for HNIs in India. I'll give you a quick introduction about ourselves. So both it's a PMS set by Anubhav and myself, and Anubhav and I come from close to 12 to 15 years of both private equity and public equity investing experience, and that is where I first met him as a budding entrepreneur, and I think this is his second venture. So back to us, Anubhav and I basically started investing back in 2007-8, where as you see what you see right now, the whole India shining story version 1 was getting played out, and so we are right now in the India shining version 2 story. So back in 2007-8, when we graduated from college, we started investing out of the funds we were working in, and I think we realized that India, because of its intrinsic nature, has some fundamental baseline strengths and has some fundamental baseline weaknesses, because of which it is very difficult to rock the boat, but it is also very difficult to steer it at the same level as what you would see the other economies, the smaller economies around you. Since you all are NRI customers, I think you would have access to other economies, information about other economies like Vietnam, China, Singapore, some European countries, and US as well. So we'll come to that. But I think that's in a nutshell what India is, and I would rather, I think, focus a lot on what has happened in the last 12, 13 years in India, which has basically made the case for India as a sustainable growth story, which is basically being growing and chugging along at a real growth rate of 7-8% in real terms and 13 to 15% in actually nominal terms when you include inflation. So that's quick thing. I'd rather go talk a little bit about our fund. So me and Anubhav, basically we run Prescient Capital. It's a SEBI registered PMS. We invest for a longer term horizon in small and mid cap companies. We target close to 25% IRR, sustainable IRR over a 2 to 5 year period. And our holding period typically in companies is 2 to 5 years, unless basically something goes wrong in a particular company. We are stage sector agnostic, and we invest across sectors, but we prefer to stay away from sectors which are capital hungry and capital guzzling. So that's in a nutshell about us.
So Sonal, just a point here,
Yeah.
like you said, capital. What do you actually mean by sectors which are which require capital or which doesn't require capital? Is it related to ROC, which is return on capital employed? What is it related to?
So-
second question in line with it is, what sectors are we talking about in terms of early, micro cap, mid cap, large cap? Are you saying that you are distributing the allocation across sectors depending on how is the company performing, or is it that you have a bias towards any particular sized company?
So you're right, Mudit. Basically, the idea for us to define, or any investor to define, a capital hungry sector is focusing on its balance sheet, and especially given the times of these tech companies getting listed, where only top line boom 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 kind of growth basically becomes the focus. Balance sheet is sometimes not considered as a matrix. So we focus on return on capital, and fundamentally we believe that a sector over a 3, 5, 7 year period has enough time and space to demonstrate its intrinsic return on capital. And if you see a particular sector always being debt ridden or generating returns of capital which are below par, let's say around 13 or even less than 13% ROE in case of banks, or for example the sectors has a lot of government intervention, for example EPC businesses, for example mining, for example other commodity oil, the oil refineries, oil PSUs. If you just basically do a basic diligence, these companies have not been delivering a return on capital which is basically higher than the basic cutoff of 15% over time. Some of the PSUs are, but generally the cutoff for us is that if a sector cannot generate a 13 to 15% return on capital over time, that sector cannot compound my capital at 13-15%, and that has been proven and demonstrated over time that in a short term a business might grow at 50%, the stock might grow at 50%, but over a longer term the return on a stock basically emulates its return on capital employed.
Got it, understood. No, so basically what we understand here is mostly the focus is right sector, where probably, as you said, right, where government intervention is not to that level, because uncertainties would then become high.
Yes.
One policy can change that sector, and then basically whatever company you would be betting on would just go down in a whistle, probably, or go up in a whistle.
Yes,
Right?
yes.
So we want to control as much as possible on the returns that we are making. I think that is where Sonal is coming from the fundamentals of how can we basically predict our returns as close as possible, where the uncertainty of a sector is as less as possible. As simple.
Exactly.
Sure.
So, and I think the second question which you asked, Mudit, we'll come to the sectors which we are finding interesting, which we are finding good as we speak right now in the second part of the presentation. So that will cover that part as well.
Sure.
Should I move?
Okay. Yeah, absolutely.
You want to do full screen? It's okay?
Actually,
It's not coming now, so just a second. Let's go to...
We're just correcting the overall screen size, guys. Just a
yeah,
second.
so where is it? Enter full screen, huh? Now should...
That's okay. I
I
think
think we
continue.
should continue. Let's do a full screen.
For sure.
Yeah,
We'll anyway
let's,
speak
let's,
more.
let's do a full
Yeah.
screen. I think that if it helps, there's a lag here, so let's do a full screen. Yeah, and start. Yeah. Enter full screen and then let's. Yeah, you can check with the lag here. So moving on quickly to. Okay, so I think I want to start rather cover about our investing. So let's focus on India as a whole first, and then
Yeah.
how we how we differentiate ourselves.
Right.
So,
So the focus now essentially to all our users is what is India shining and how is it compared to other economies? And we are going deep down now to understand what effective sectors are working, what not, etc.
yeah. So quickly jumping to that, I think you've seen enough data from like different development agencies, different bodies to say that India has been growing at around 6 to 7% in the past, and the post the rebound in COVID, it has demonstrated a growth at a similar trajectory, even post COVID in FY21 and FY22. Should I continue? Okay. Escape.
This way it is working.
This way is working?
Working.
Yeah, go on.
Okay, cool. So you would have also seen like India market being benchmarked to other large economies, and I think if fundamentally an economy is growing at a stable rate, so does its financial markets, and you would see like India has been outperforming the other larger markets like US, Shanghai, US, China, Japan, and other developing economies other large developing economies by and large, because of the fundamental growth that the Indian economy is showing. So I want to just step back and go back to 2008, and that's why I said 2007 was the version 1 of India shining and things happening. So back in 2008, post the financial crisis, what essentially happened around the world is that everybody focused on providing stimuli through debt, and what that really meant was that they were basically providing artificial injections to an economy which basically had some root cause analysis to be done, that why is this economy in a nutshell not growing, and stimuli after stimuli, and hence you would see, let's say, economies like US in terms of its debt to GDP, economies like China, which were financially fairly, I would say, disciplined pre the first financial crisis. Actually, everybody went through this entire debt trap over the course of 2008 till 2022. You would also see, I think, so in this chart, you would see that this is fine. Yeah.
Mm-hmm.
So in this chart, I think you would see. So you can zoom.
You get it out.
Yeah,
that's fine.
Yeah. So in this chart, you would see that India and Germany are the two economies which basically have held their ground over the course of last 14-15 years in terms of their overall prudence, in terms of their debt levels. Now, what that really means is that basically the economies have not gone beyond their means in terms of spending. It has made their collection systems fairly robust. Germany, any which ways, has, and India has done incrementally through digitization, but we'll come to that later. But basically, if the fundamental economy and their let's say the watchdog, the RBI in our case and Bundesbank in case of Germany, essentially what has happened is that they have made sure that there are very few shockers in the economy over the course of last 15 years. Now, what that basically means is that businesses can focus on their own business than actually focus on volatility, which are driven by macroeconomic indicators. So hence, what I want to highlight through this particular slide is that we have been in a fairly stable macro environment from a fiduciary responsibility of RBI perspective for the last 15 years, and that I think is something which we should all, I think, give kudos to RBI, because if they were not there, I think we would have been in a situation similar to what Argentina is seeing right now, similar to what Turkey is
So
seeing.
basically what we are trying to say is debt to GDP is a very important measure to understand.
To understand that are you in an economy or a bubble, and are you basically in an economy which is stable and fundamentally following basic discipline of spending only based on its own collections.
Right, exactly. So yeah, I think we can go ahead. So debt
Yeah.
to GDP from an India perspective has been pretty
Fairly stable.
Yes, and thanks to our probably RBI for
And,
doing that.
which runs across governments, I guess. Second part, I think the pandemic, just to summarize, the pandemic basically has created kind of a dent in already ballooning balance sheets and debts of these countries, the countries which we mentioned earlier, and different countries provided different form of stimuli to keep themselves abreast. Countries like India and China were basically the lower of the order in terms of providing stimuli. Hence, they still maintained their financial prudence in terms of what they provided as stimuli, compared to countries like UK, compared to Australia, compared to US, which basically kind of opened kind of a Pandora's box. They doubled their overall debt levels in the country, and hence basically the problem became magnified in these countries. So in a nutshell, this chart basically came out today from Bloomberg. And I was discussing this with Mudit before this presentation. I think fundamentally as a country we have been able to avoid shockers, volatility at the macroeconomic level, and hence we find ourselves as a country in a sweet spot compared to the countries, the other larger economies, other developed economies, other developing economies, and hence the odds of recession hitting, which you might see in UK, which you might see in US, and which you might see in, let's say, even China, for a change actually, the odds of recession in these countries are far higher than what you would find in India. And hence, I would say that for anybody who's kind of a global citizen, not only an Indian citizen, basically, it is almost important to start their allocation for India, if not already, or basically increase their allocation to India, because fundamentally we are in a very stable economy which supports businesses, which is provided kind of an amenable environment for the economy to grow at 14-15%. So
But Sonal, like I would say that we are Indians and we are running a fund here. I mean, to be very honest, everybody would say that. Why would we not? Why do we, or why should you validate it from a lens of a fund manager, saying that I'm sitting across the globe and I'm now analyzing various geographies from outside and seeing ki a recession ki probability, what is the recession probability, and why should I fundamentally believe? One, I understand from a debt to GDP, as we just explained to our user, one is that fundamentals. Is it also some kind of behavioral tactics or characteristics of Indian users, like, for example,
there are some secular trends. There are some secular trends.
Exactly. Can you please highlight that?
Exactly. So I think that is the next section, basically, that okay, fine, India is shining. I think we've been talking about this for the last 20 years and we've lived through all of this for the last 20 years. But I think there are some fundamental changes which are happening in the economy, which are good, which are kind of secular in nature, and that gives us some understanding about why we are so much enthused about investing in India. And please don't consider it in any manner that basically we are saying don't invest in the US, don't invest in Germany, don't invest wherever. We are, I think, just making a limited point here that India, from an intrinsic and a bottoms up and a top down perspective, looks very interesting. Maybe Germany also looks interesting, maybe Singapore looks interesting. We are not an expert in that, to be honest.
Got it.
Right? So moving on to the secular trends. As all of us know, I think our parents have lived through the generation, and so have we as kids, wherein savings in FDs, savings in banks, savings in any fixed deposit was basically something which was kind of bread and butter for our economy to hold its ground over the course of the last 70 odd years. This money has actually fueled the growth of banks in India, the lending system in India. But over time, what we've seen is that as the economy is evolving, the financial literacy of the economy by and large, and their understanding of financial products basically by and large, is something which is growing. Now, you can say this is a good secular trend, but what this is actually doing at a baseline level is that the volatility in our economy due to money being pulled out by FIIs, by global events, has actually shrunk. So if you consider, for example, 2008 as a proxy and compare it to, let's say, events which have happened in the last 2-3 years, in 2008, when we were, I think, when we were younger by 14-15 years, we could see that, let's say, if the top 10 FIIs basically in India would pull out money, stocks would tumble by 50 to 70%.
Yeah, for friends, FIIs are foreign institutional investors who basically put in money as institution into India. Now, what happened in a developing country like ours, FII would pump in money and the stock market would become volatile.
Yeah.
They would basically get the money out and then the stock market becomes volatile. What has happened because of what Sonal is explaining is our core domestic economy is so sound and so strong now because of the savings that have been done, that the volatility of people of foreign institutions putting in money or pulling out money is very less because of the domestic market becoming very strong as with time, is what this graph basically shows.
So what we are trying to, I think if you look at the overall economy, the money flow in the economy has been growing at a CAGR of 13 to 15%. The money in the markets, the domestic money in the market has been growing of the order of 20 to 27%, give or take whichever time span you take. And that basically creates kind of a bedrock for the trust and the stability in the underlying markets, that whatever may be the reasons.
When you say money flow, is it in the bank accounts or is it in
the mutual funds? It's in the domestic mutual.
Okay.
So you're talking about domestic mutual funds, you're talking about direct equity, you're talking about AIFs, you're talking about PMSs like us. So anything which is linked to equity.
Understood. Is it because people have started in the domestic market, the residents have started putting in money from bank accounts to the domestic equity?
Yes.
Is it because
yes?
of that?
So basically, I think the first principle for any household is to first create kind of a bedrock of saving.
Yeah.
Basis which they maybe buy a house first of all, maybe they buy a car thereafter, and then thereafter there is kind of a discretionary spend. So financial investments basically initially were considered to be just a discretionary spend.
Right.
Now, basically, as the economy evolves, as the confidence of the of the younger generation and the elder generation, the economy grows, it has become kind of a baseline need.
I see it from a different view, from a layman perspective, and to all of you, just to understand it this way, that we have our grandparents who basically helped us eat food. We have our parents who helped us buy house, and we have us who just basically have a house, have food to eat, have clothes to wear, and now we focus on investing.
Yes.
So I think this is the basic fundamental of any country which has become independent. This is how it has evolved.
And that shows you the depth of the economy at the baseline level.
Right.
Very well put there, actually. Right. So, moving on to the next chart. So, moving on to the next part, I think over the course of since 2008, there was a kind of a pressure or a balloon basically which was building in the banking system, largely the PSU banks in India, and even the private sector banks were not alien to this. So what fundamentally was happening was that since 2007-8, a lot of capex which happened was done in anticipation of fast growth in the economy, which got shuttered in the 2008-9 kind of a global crisis, which created maybe contraction in global demand, which created kind of a contraction in overall demand in India for a 1 or 2 year period basically. So what really happened thereafter was that we started seeing swelling up of balance sheets of banks as well as companies in India. What that meant was that companies were not able to retire debts, or they had invested ahead of time and in anticipation of growth, and they were basically finding, since the global growth was not coming, or they had invested ahead of time, they were not able to service their debts. And therefore it is often said that between 2008 till 2017-18, it is considered to be the dead 10 years for India. Because the only sectors which basically did grow in India at that time was consumption, because consumption does not require a balance sheet.
Got it. Can you please be more? I think this is sort of a bit complicated. I think 20% of users would have understood it. If I'm
So
not wrong.
I'll explain.
Just explain from a layman terms.
So I think keeping it simple, basically in an economy, when large projects, large manufacturing projects basically require banks to lend them.
Right.
Their companies cannot create so much cash flow from their own balance sheet. Hence, they typically say, let's say 70% debt, 30% equity,
Right.
and the debt needs to come from the banks.
Right.
Now, what happened was, since the banks were sick
Right.
from 2008 till 2016-17,
Right.
and they were running at an NPA of 7, 8, 9, 10%. Any new demand that used to come to them, they were like, no, we're not going to do it.
Okay, so
I am
basically
any which ways,
they
I
were
am any
very
which ways.
cautious of giving lending.
Yes.
Because of which lot of businesses could not grow to that level.
So they were trying to basically clean the mess from
I
the
understand.
last 10
Yeah,
years.
yeah.
And hence, any capacity building exercise, any new capacity, any growth engine in the manufacturing per se
Got it.
was stunted.
Understood. So last 5 years, this was not the case, and
Yes.
that is why as lending was growing, more businesses were growing, and we are seeing high growth of businesses at least in few sectors.
Yes. So what I think this government from basic, and it, I think again thanks to the savings by retail janta in India, I think a lot of deposits, the CASA money came into banks, the public deposit, and the banks slowly over a 10-year period were able to
Recovered.
clean their balance sheet.
Got it.
They were recovering, and hence you would find that post 2017-18, the non-performing asset, their balance sheet started improving, and these banks basically then said, okay, we are ready to actually finance infrastructure, we are ready to finance
Understood.
manufacturing,
No,
power.
so I think a very, I think, I don't know if people have thanked, but I would really love to thank all our NRI users because their NRO deposit really helped.
Exactly.
Right?
So
Yeah.
NRE, NRO money, I don't know what the rate is, but I think the largest way in which the money has been coming in domestic and foreign deposits, this is the real impact of this particular thing. The same problem got created back in 2000, it got elevated in 2007, which led to one rally in the market
Right.
in that period. So we are seeing the same. If I could extend this chart, you would see another mountain being made back in 2000, the mountain sloping down back in 2004-5, and the market peaking in 5-6-7.
Right. So it's always been cyclical, and I think it would be that way according to how
Even further.
Right.
So you are seeing through this chart that basically the balance sheets of PSUs for the first time in the last 15 years are in pretty clean condition, even after so many global scams which have basically happened. So hence we are seeing that basically everybody is in a position to lend. So lending is not a bottleneck, which is actually a problem for India. And compared to other developed economies where lending is actually not a bottleneck. So, like for instance, US similar choke points actually don't get created, but in India these are choke points.
Right. It was there, but is it now?
It's not. It's not. And hence, I go to my next slide. Is that which is where we're talking about the blue line here. So government is also very confident about basically that given the fact that the banks are clean, given the fact that the government tax collection system is working, which is the orange line here, the government is actually basically going gung-ho, and it's actually the largest spender right now in infrastructure, manufacturing, development projects, which are basically the bedrock for like 10, 20, 30 years kind of a growth spurt in a particular economy. We've seen in other countries.
So what we're saying is if a government is investing more and more in infra, or you know the bedrock of the whole economy, the other jobs basically starts getting created.
Exactly.
More and more people basically get jobs, more and more economy basically thrives on this, and that's why if it happens, then the government is doing well, the consumption is
so
doing
it is
well.
kind of a step function. Because government has the most risk-free asset, the money, because they own the money. They start investing first. The manufacturing starts, the private sector starts investing thereafter. The money flows to retail and people like us. We start investing, and hence the cycle basically goes.
And from this graph, what are we seeing that is the government, because of more tax collection, the government is able to spend more within the country for growth?
Yes.
Got it. And why do you think this tax collection is increased? Is it because of the GST thing? Is it because of the government, or is it because of the Indian consumers?
So I think there is a fundamental shift which is happening in the economy, which we don't talk about. I think each one of us in our own corridor chats have always said that 50% economy of India is in black, and 50% economy of India is in white.
True.
So post GST, what has happened is that our economy is not growing at 25%. but the collections of government in terms of GST, everything is basically growing. So what is happening? That basically the government, because of GST implementation, has been able to year on year make the net for people who don't want to run the business the white way tighter and tighter.
Right.
They have people like us, smart. There are friends who are from college. They basically income tax GST commissioners who basically have enough data to pinpoint one guy in the chain,
right,
and then pick up everybody in the chain and say everybody is a defaulter.
Brilliant. Got it.
So therefore, I think the financialization of an economy is a real thing here. I don't know whether thanks to this government or maybe let's say the 10-15 years there overall as a period, but that is something which is bringing more money, which money is basically flowing into government investment, the money is flowing into banks are well capitalized and they are therefore lending. So that is the story.
Got it.
Now, one thing which I want to, I think, go even further, the underlying theme which is a little less macro here is that we are also seeing our some fundamental shifts in sectors basically which were earlier considered to be kind of very simple, steady, and no kind of innovation was happening in those sectors. And some part of this is attributable to the government. We may say the government needs to do more to create an electric hybrid vehicle ecosystem similar to China, but I think we are still like 10-15 years behind. So what the government is also doing with the surplus cash basically in its pocket is it is helping some sectors to actually become grassroots real growth engines where India becomes kind of the center of manufacturing overall basically. So Indian government is basically through its subsidies, through its push to find local vendors within, let's say, manufacture in India, kind of an ecosystem. They are trying to push kind of new sector ecosystems to be completely self-sustainable within India.
I have a question, Sonali. So basically, I see whatever you are going through, right? GST, all these few things. In few of the sectors, we want domination. You know, we have established domination in fintech through UPI, as everybody knows now. My question is, why did this not happen earlier? Actually, is it because of the government actually or the policies, or is it because India is experiencing a behavioral change on a whole?
I think sorry, you continue.
So I basically want to understand from a macro perspective that all these things that you're saying, right, from debt to GDP ratio, all these are macro factors. Now we are going into micro factors, but this is also governed by a macro factor, which is possibly a policy shift, a policy thought. So is it that it actually, what I'm questioning is it actually Modi or let's say the overall government, or is it actually the thought that now we are at a stage where we can actually take all these risks and become, a market leader across?
See, so Modi or non-Modi, I think basically I can say that we are running through a government cycle where there is clear majority.
Okay,
Because of which policies are getting implemented in a aggressive fashion. You don't have to wait for fringe marginal partners to basically give you approval, which was kind of the legacy of the elephant as we lived with. Right? And what I basically believe is we're still far away from it. We've seen in the farm bill, we've seen in the land bill, the labor bill, which are three big animals basically sitting in the room and nothing has happened there. So that is the contrary to what I would basically.
So a stable government because of that, decisions faster and implementation quicker.
And I think what has also happened is that as we say that sometimes when over the course of last 10-15 years, I would also attribute a lot of growth to basically grassroots level of entrepreneurial spirit. And we're not talking about the SOV like funded startup. We're talking about sectors which have gotten shaped up. I'll cover more about the pharma sector, for example. But just talking about pharma as a sector. So we all talk about IT as a sector, right? But pharma is where IT was back in 1995 in India right now.
Okay.
So as we see right now, the whole pharma value chain, we may leave the basic chemicals like sulfides, basic bromines or whatever, where China is dominant and power consumption plays a large role. But we have a fairly, I think, a distinct advantage over China in actually formulations in APIs and in the intermediates, which are complex chemistries, which are like 1, 2, which are 3 to 5, 7 stage, even 10 stage kind of chemical reactions. So now that is kind of coming back to the point that is something which the entrepreneur have developed themselves as a whole ecosystem. So pharma is one sector. Over the last 10 years, 15 years, we've completely made our own pharma sector outward focus. And we are globally competitive. If not, we've seen through COVID as well. Probably will be the number 1, 2 industry globally in terms of pharma manufacturing and supply chain.
Got it. But was it not there in 90s? Was it not there in 2000?
No, it's just a phenomena post 2005-6. It was there. Manufacturing was but not at par. So, for example, if you want to supply raw material to intermediates to US, you have to go through US FDA approval. You have to go through EU approvals.
Okay.
Those approvals were not common knowledge here.
Right.
Plants used to fail miserably.
Right.
And we've seen in case of Ranbaxy, like the whole plant, there was no compliance, but there was compliance on the other side, right? But all those kind of things have completely vanished from the ecosystem.
And why did it happen?
And because people have said, listen, if I am going to be doing this, I'm going to do this the right way.
Got it.
I will find people, talent, supply chain, and I will become globally competitive.
Got it.
So that I can actually address the overall market by and large.
Understood.
Exactly what happened to IT, right?
Right.
So pharma is one sector which basically is completely, we still like in the middle of the journey in terms of it becoming like an IT sector.
Got it.
And I think when I show this auto chart, auto again is an example that earlier I think the whole auto industry and the auto ancillary industry was kind of a sleeping giant kind of industry where the incumbents like Bajaj, Hero were basically products of license Raj. I'm sorry, I'm not I'm using very harsh word, but basically it was kind of a
license Raj, meaning the age old industry.
Yeah, so the whole industry used to run on connections.
Right.
Simple.
Right. But now what happened?
Now what happened is, so in the last 10 years, I think some people basically said maybe we'll be able to run this in a similar manner over the course of next 10 years, but that didn't happen.
Got it.
That created kind of a way in which the companies readied themselves for demand in India, but demand didn't come.
Got it.
Right?
Got it. Yeah.
And hence they were forced to look out that अगर मैंने R&D नहीं करी, if I'm not spending 2 to 5% of my top line my R&D,
right.
and if I'm not becoming, let's say, a vendor to Yamaha, a vendor to, let's say, a Volkswagen or a BMW or an Audi, I'm wasting my time.
Got it.
Okay. Right? So that has happened over the course of the last
so it's
years.
a mix of stable government, the entrepreneurial
So the government gives you the way, and then you have to find your own way. Right?
Absolutely.
So it is happening in pharma, it is happening in auto, it is happening in banking, as you talked about the fintech revolution, which I think the best fintech company in India is still ICICI Bank.
Right.
By and large.
Yeah.
Right. There no financial services, other startup or whatever can compete in the system.
But no offenses to NRIs, I know there are positives and negatives about banks handling them. But anyway,
yeah. But in terms of their tech infrastructure is what I'm talking about here. So that coming back to that point, I think it's a good digression. So basically, we now move to the next point, which is also linked to like the larger macro trend, which is feeding into the sectors we were talking about. So I think everybody's been talking like big thing about China plus one happening, and everybody from India to US basically in their boardrooms have been talking about this. I think it is happening. It is not happening to the extent that we thought it would. Therefore, I have written China plus 0.25, then actually China plus 1. Basically, because
can you explain this more?
Yeah, so the it's kind of it's a lighter way of explaining this. That see, China, because of what happened in the last 2 odd years, which was basically geopolitical instability, supply chain shocks, and high tariffs which were imposed in the freight routes during the COVID period. Every company from which had a global footprint or a global manufacturing supply chain has been forced to think about, should we consider the alternatives? And this discussion has landed into the boardrooms of companies which have headquarters in the US, in Europe, in Asia, and everywhere. I think we've figured it out in our calls, in our discussions with people, that this is kind of a real thing. So it's a kind of a contingency plan that everybody has to plan for over the course of next 5 to 10 years. So China plus one is real, But
what is the meaning of China plus one?
So everybody has to find an alternative vendor.
Okay, understand.
And so basically the best scenario would be that you find at least 3 vendors in 3 geographies.
Got it.
So your supply chain doesn't get disrupted.
Understood.
Simple, right?
Right.
But what has happened is that because of what India lacks, the entire benefit of that is not falling into India.
Got it.
Countries like Vietnam, which is like a beautiful case study in terms of the infrastructure they're building, the kind of perks they're giving to companies to come and set up plants.
And what is it that is lacking in India, which is?
I'll explain. So first, the 3 things which I mentioned: the land reform, the labor reform. Basically, these are 2 things which, and to an extent, I would say some part of logistics also plays a role, but it's lower down the value chain. But main part is labor and local policy, basically that around labor, which basically makes India not the most preferred destination when we compare it to other countries like Vietnam and Thailand. If you see, Vietnam is actually, so net imports of US from Vietnam are higher than the net imports of US from India. Last I checked, basically. So hence, it is a theme, it is playing out, but it is playing out in a way in which basically we may be one of the 4 or 5 countries which basically reaps the benefit.
It's like business competitors you have, and you have one of us.
Yes.
As one of
so
the
it's
countries.
not a monopolistic kind of a swing basically which is happening. So, but it is happening in the sectors which I mentioned earlier. It is happening in pharma, it is happening in chemical intermediates, it's happening in specialty chemicals, it is happening in auto supply chain. It is happening,
which is basically China plus one.
Which is the China, exactly, the China plus one
model
is happening in all these sectors. So people are thinking, and it is happening in.
And do you think this is why it's actually directly showing on into the economic growth as well?
It will show. It's still not showing. So the chart that you see on the other side, basically the black chart that you see here, it shows India, China and Vietnam, and it shows the merchandise exports from India. We are growing, but we are growing slower than China, we are growing slower than Vietnam.
Right.
So a lot needs to be done here.
Right.
And the effects of this will happen in the course of next 2, 3, 5, 7, 10 years.
Got it.
That is the
are these your favorite sectors? Are these your favorite sectors to put
so we will come to that. These are my favorite sectors as well.
Got it. I think a lot of it has been discussed on the overall thought.
Yes.
Let's just summarize it for users a bit.
Yeah.
From an overall sectoral perspective or from an overall governmental perspective, I think as we just listened to it, right? Debt to GDP ratios, stable government, entrepreneurial spirit increasing more and more. Because of all that, and then obviously the sector-wise thought process, as Sonal just mentioned, has helped us grow from where we were probably in the past 5 years. And now the thought is, what is in future? What is the next 5 years about? And I think we are going to ask Sonal about his own thought process as to how is he seeing present, what is his thought around which sectors, and why does he focus on various factors or sectors which basically are going to grow.
So these are the 5 sectors, to be honest, I think we are investing in right now. And first is BFSI, and as I think we've covered the backstory of BFSI. There are some fundamental things which are happening in India that leverage is reaching basically people who have kind of an organized salary, but they don't have a CIBIL score.
Okay.
So when leverage reaches, the first thing somebody does is he takes a home loan. Hence, affordable housing is becoming a core bread and butter kind of a theme for good NBFCs to run around. So we've seen good NBFCs like GRU, Canfin, even HDFC, which is a large institution, and couple of other NBFCs basically doing exceptionally well because lending by and large is reaching people who were.
Why is it happening? Like, is it because of the banks? Or
so the lending models basically
the fintech models.
The lending models have become far more adaptable to finding risk for people.
Okay.
First of all, when you earlier used to, like 20 years back, you used to go to a bank and say, I'm not, let's say, an organized salary guy. Right. He would say just buzz off.
Right. Absolutely.
But now, basically, because of whatever our financial models, the way in which we calculate risk, basically, we are able to allocate risk to every profile of person. And that.
Can you give an example of?
So, for example, let's say there are 2 types of people. One people basically are salaried and people are self-employed.
Right.
Self-employed people rarely used to get like kind of a loan from the organized banking system.
Okay.
But that has changed to that is actually changed now.
Okay, why? What happened?
Because, for example, banks can actually say, fine, I can look into your accounts.
Right.
Let's say you open your collection account.
Right.
Let's say if there is a guy who runs 5 vegetable shops.
Okay.
Right, simple. Earlier he would not get a housing loan.
Okay.
Right.
Okay.
Now what somebody will say is, okay, fine, you open a bank account with me. I see data through my tech system of the regularity of your income,
Right.
regularity of your
Got it,
expenses.
got it.
I find out that every month you are able to save 70,000-80,000 rupees.
Is it because of a bit of UPI as well?
No,
Because
just tech,
everything
tech,
going digital.
just tech.
Everything going digital.
Everything going digital, and hence you have far more data to punch on.
Exactly. Absolutely. Right.
So that is like one part of it. And therefore lending by and large is reaching more and more people.
Understood.
And the same guy is therefore also able to take a mortgage loan on an existing house. For example, if I am a pharmacy, one pharmacy shop, let's say in Bhopal, right, I am not able to take working capital loan in the 20 years back,
right,
but now I am able to,
right,
for the same reason,
right.
So that is happening. So lending, therefore, one is happening. The other part, I think, again, credit cards are becoming credit, and to your point, digitization has made the whole credit process completely virtual.
Got it.
And KYC systems, KYC processes have become far more robust. Collection systems have therefore become far more robust, and hence banks don't mind running a full-fledged credit card business, which was not the case, let's say 10 years back.
Got it.
Earlier they would always say, I will keep the credit business out because it is running at an NPA of 12-15%,
right,
and I can't take that risk in the core bank.
Got it.
Now that has become bread and butter.
So can we say that because such a beautiful data has been coming because of the whole digitization of this overall industry, we are far more better in the perspective of lending, credit,
Exactly. So, for example, if today you were 20 years back, you were working in a non-MNC, non-government setup, the chances are that you would not be able to get a credit card.
Got it.
Right now, there are the processes are there. So
understood. So that's why BFSI is one of your favorite.
BFSI is the thing.
But then when you say BFSI, is it the larger banks or the smaller banks?
The smaller banks, the smaller regional banks, because larger ones are well discovered. The smaller ones basically, see, in BFSI, it is not the speed of the race.
Okay, right.
It is about
fundamentals.
The fundamentals of whether you running your race slowly, gradually, at your own pace, at your own risk appetite.
Got it.
And that is the turtle basically which can run for 18, 20, 50 years.
Got it.
Right? So those companies, those banks, we can come to that later, are basically good lenders for MSMEs, which were mentioned here. They are good lenders for commercial vehicles. They are good lenders for.
So that's one of the themes on BFSI,
where
you see that it has to be driven by fundamentals. And these are the sectors which are booming, and so this is one of the
good balance sheet prudence.
Good balance sheet
in BFSI.
Got it.
The second part, I think we already mentioned that manufacturing is booming. If you look at, as we analyze calls bottoms up of each and every company in the manufacturing sector, we are seeing that fundamentally that everybody, like 80% of the companies basically that we study, are in a capacity expansion cycle.
Right.
Or a cycle which has already been consummated, and hence they will be reaping benefits of that capacity build up.
So can you please explain more to our users capacity?
So they are expanding. So for example, they are growing from 3 plants to 5 plants, or they are going.
And their demand is set. Everything is growing. Just that they have to set up their manufacturing.
So some companies, for example, chemical companies, if I may just specialty chemical companies, if I may just use, let's say they are seeing that, for example, a mix of China plus one happening, that costs have become so high in China that vendors want, China doesn't have a dominant cost base, because of which if Indian companies are supplying something 100 rupees, China will be providing it, let's say 60 rupees.
Right.
It's no more that difference. So now it is like if India is 100, they are 90. So they say, fine, let me find another vendor. Let me find an Indian vendor. They, any which ways, let's say, are right now procuring, let's say 20 units of something from India. They might say, fine, we are interested in buying 50 units from you over the course of next 3 years.
Got it. And why has this 190 happened?
Because the cost base in China has gone up. The subsidies in China, China used to give in power,
have reduced.
Have gone off. Their banks have become, like in our case, our banks have become very healthy.
Right.
In their case, their banks have become very unhealthy.
Right. Okay,
So
understood.
right now, if
this
Indian
is a
bank-
shift that is happening in the
which is
past.
so it is the kind of we don't understand China by and large, but I think in India the good banks in India run at a, let's say, a non-performing asset of 2%, 1.5%.
That's it.
That's it. In China they run at, let's say, 10%.
Oh, that is
And-
like a 8x difference, like 8
Right,
times.
and therefore we have seen that, and it's an opaque economy, at least to outsiders.
Right.
And hence you can only see the overall economy or a sector becoming kind of accelerating or slowing.
Got it.
We seeing manufacturing therefore becoming at par in level terms basically for India, and hence we see different segments in manufacturing doing fairly well. Because of this capacity expansion, there is always a need of power. So, example, when you set up a new plant, you will set up a cogeneration plant, or you will set up, let's say, a larger supporting power setup, and hence you would see demand for boilers, turbines, generators. You would find the entire power ecosystem basically going fairly well. You would also see the government actually working on transmission, but also a lot of companies basically emphasizing that, listen, if I am producing, if I need 30, I am producing 50, I need a way in which the 20 can be given to, let's say, back to the grid. And hence the infrastructure in the grid basically is going.
Right. So basically you start from the macro, then you go further micro, then you further go into association of that micro with other industries, and then you further go deep into it.
It's like the onion. So macro बोलना कि इंडिया में चाइना +1 हो रहा है, that doesn't kill it.
Right.
You can slice the onion 5 ways.
Right.
And therefore you need to find a way in which you find the most honest, most hardworking entrepreneur who his business is basically ready for growth in the next 3, 4, 5 years, and his company is available for at a reasonable price for us to buy.
So ये जो आपने अभी बोला, I think most of us know this, right? आपको सही प्राइस पे सही कंपनी चाहिए, सही मैनेजमेंट के साथ. That is fundamental. I think everybody would understand. Why should a person who is sitting outside the country trust you only? Because there would be a lot of others as well. Like whatever you said, yes, we understand the fundamentals that you play on, and we like it, to be honest. But the point is, what you just said, सही price पे सही company, सही management, etc. is general to all. What is it that you push yourself extra to finally give us a return which you have proven historically? Can you please highlight that?
So, see, I'll just come back to what differentiates also. But basically, I think in a nutshell, what we have learned over the course of last 15 years is that, which I think maybe 4 or 5 of our peers do, or by and large, we're the people whom we respect also. There's a mutual professional respect. Basically, but in the industry, by and large, people fail to spend inordinate time on understanding whether this management is ethical.
Okay.
Are they aligned with making the shareholder, letting the minority shareholder make money? Have they had a track record of basically digressing themselves into sectors which are politically exposed? Have they been good capital allocators in the past?
Mm-hmm.
And if you do that diligence, have they filed their income taxes well?
Mm-hmm.
What they say is what they do. There is no hanky-panky dealing in the background. And I think this is an effort which requires 6 to 8 months of analyzing a company, talking to companies' vendors, talking to companies' customers, talking to companies' competitors.
Mm-hmm.
Talking to
so
income tax
before
department.
deciding on a company, you just focus on the management like the first criteria.
Yes. So and management is the first criteria.
So if I have to ask you that, you get to know a specialty chemical company, which has a China +1 theme, and is growing.
I will not start jumping up and down after that.
Right.
Exactly. That is what typically.
And it's
happens.
growing at 40%, right? Pat.
Yeah. So we get tips, feelers, whatever from our friends that this is doing well. This is like first thing. Have they done anything wrong from a professional construct from the last 1 to 5 years?
Got it.
And because see, it is this DNA which is a kind of a hard memory which does not change.
Right.
And we spend 50 to 60% of our time to identify. हमने जो इंडिया में 5000 कंपनीज हैं, उसको सबको अपने फ्रेमवर्क में डाल के 200 से 300 ऑनेस्ट एथिकल प्रमोटर्स ढूंढ लिए.
अच्छा, तो सबसे पहले अपने मैनेजमेंट चेक
हमने सारे
और
हम सबसे पहले हम 15 साल से करते आ रहे हैं. ये बकेट में नई कंपनी जो आती है आईपीओ में, उनसे इंक्रीमेंटली मिलते हैं, हर क्वार्टर या 6 महीने में मिलते हैं. तो हमने इंडिया में जो कंपनीज हैं जो इन्वेस्टेबल है, मान लो जो 200 करोड़ से ऊपर जिनका मार्केट कैप है, हम उनसे मिले हुए हैं, मिलते रहते हैं, और उनमें से हमने 200 से 300 कंपनियां बेसिकली इन्वेस्टेबल ढूंढ ली हैं। मैंने, मेरे पार्टनर ने, हमने ये काम किया, हमने यही सीखा है।
तो ये तो काफी मतलब 10 साल लगाया आपने इस चीज पे कि यार कौन सा मैनेजमेंट
ये बंदा साफ सुथरा है कि नहीं है।
बहुत ये इंपॉर्टेंट बात है, राइट? आप किसी भी कंपनी पे पैसा लगाने से पहले सबसे पहले चेक करना चाहते हो चला कौन रहा है।
आप घर में अगर मान लो किसी को पैसे भी देते हो लोन पे, तो
हाँ।
आप पहले ये देखते हो ना कि ये बंदे का
वापस देगा
कि नहीं, वापस देगा कि नहीं। तो पहली चीज इन्वेस्टिंग का सिंपल प्रिंसिपल है कि मुझे रात को नींद ढंग से आएगी कि नहीं आएगी, इसको पैसे देगा कि नहीं।
सही बात है।
और हमने इसीलिए वो सैंपल सेट आइडेंटिफाई कर रखा है। दीज आर इन्वेस्टेबल कंपनीज। अब नॉन इन्वेस्टेबल सेट कंपनीज में से बहुत सारे फुदक के इधर आते हैं कि ये 50% से ग्रो कर रहा है, ये इसको कुछ कंफर्ट का टेंडर मिल गया है, इसको इसको चाइना +1 से फायदा होगा, या इसको PLI से फायदा होगा। हमारे लिए है कि, और पता है क्या है, हमने ये देखा है कि हम गलत भी हो सकते हैं कई बार, लेकिन आदमी की जो फितरत होती है वो बदलती नहीं है 5-10 साल में। वो कहीं ना कहीं बेसिकली आपको वो या तो वो अपना स्टेक बेचना शुरू कर देगा पीक स्टॉक प्राइस पे, आपको कुछ और इन्फॉर्मेशन बोल के कुछ और डिलीवर करेगा। हमने टाइम एंड अगेन देखा है कि आप अगर अच्छे ऑनेस्ट डिलिजेंट प्रमोटर के पीछे दे रहे हो, आपका प्रोबेबिलिटी ऑफ परमानेंट लॉस ऑफ कैपिटल ओवर आफ्टर 6 months ऑलमोस्ट 0 हो जाता है। Which is the first principle of investing.
Got it.
कि आपने किसी को पैसा सही बंदे को दिया, आपने पंड के बेस पे, आपने किसी ग्रोथ मैक्रो स्टोरी, PLI, इंडिया शाइनिंग, चाइना +1, डिजिटाइजेशन, फाइनेंशियलाइजेशन, ये जो भी अभी तक हमने बोला है ये थीम्स हैं,
राइट।
इसके बाद ये है टॉप डाउन थीम, इसको बस्ते में बंद करो, उसके बाद हमारा काम चालू होता है।
राइट, अंडरस्टूड। तो क्या आपको लगता है, सो फॉर एग्जांपल आई हैव सीन अ लॉट ऑफ NRIs एंड माय रेसिडेंट फ्रेंड्स एज वेल कि यार हम स्टॉक मार्केट की रिसर्च खुद कर लेंगे, वी विल फिगर इट आउट। I am myself not that person because I believe that someone who is doing it 24/7 analyzing all this would do it better than me. Is it a yes?
Over time वही होता है कि आपको देखो, या तो आप किसी सेक्टर में एक्सपर्ट हो, जैसे there are friends who are IT sectors specialists because they've let's say joined TCS, Infi back in those days, right? I actually go to them and ask that is KPIT honest management?
Got it. Understood.
I ask them, is this company an honest management? And they will have the 5 honest promoters in the zone that I'm talking about.
Right.
I don't need to talk to 500 other people.
Right. Bilkul.
Right. So they would do that. But if that same guy says, I want to now invest in chemical, he cannot replicate his 20 years of experience.
Completely agreed. Right. Bilkul.
Right. So that is the cumulative journey for him. That is the cumulative journey for me.
In short, guys, if you actually understand India and fundamentals of India from a perspective of management also, and if you have connects, if you have that sector understanding, then only I will tell you that you go ahead.
Maybe that also in your own sectors that you are in. For example, if you are in IT, real estate, you are in, let's say, EPC, you may find, let's say, the cleanest management in EPC is somebody, right? And you put money. That's fine. That is what we tell anybody in our friend circle. That's how you start with investing in your core domain.
Right.
So that is the first principle. We spend 50-60% of our time. That reduces odds of permanent loss of capital close to, let's say, 1 or 2%. It comes down to that number. We've statistically proven that.
Statistically, if the management is good, then at least we avoid the concept of loss
99% cases you will not lose capital, right?
Okay.
Second thing is that you say that am I able to understand this business better? Right. That is where the whole private equity or the investing background, longevity of investing comes in, because I am not looking at analyzing a business from a 1 tender basis or from a 3-6 months basis or let's say a 9-month basis. What we are saying is that am I able to see this business grow, its earning grow at least 20% sustainably over the next 3 years and 5 years?
Got it. Understood.
And वो जब sustainability वाला word आया था ना, then you need to dig deeper. You need to look at the competition. You need to look at, let's say, the peers. You need to look at vendors. You need to look at everything on the margin front. For example, even if I'm top right on top line for the last 2 years, everybody has been wrong on margins. Right. So which is the other part of it.
Right.
So therefore, understanding a business from a longevity perspective requires financial as well as non-financial understanding of the business का moat, उसके intrinsics, उसकी competitive advantage and everything around it. So that is the second part of it. Right. The third part, which is the only part in our control, because पहला promoter जो है वो है, business जो है वो grow कर रहा है अपने हिसाब से. तीसरी चीज है the financial investing discipline of valuation. Right?
So you mean right price पे buy करना?
राइट प्राइस पे बाय करना. सो हम क्या करते हैं कि हमारा एक कंपनी पे अपना थीसिस करने में 8-9 महीने लग जाते हैं. बट फॉर अस टू एक्चुअली फाइंड दैट कंपनी एट द राइट प्राइस, एट द प्राइस वी वांट, विच इज टिपिकली द बॉटम 10 to 30 percentile of valuation of that particular company.
Okay.
उसका PE multiple.
Okay.
Basically, it takes us 2 to 3 years also to wait
for it. Okay.
To wait for that price point.
Okay.
Right?
Okay.
So what happens is there are macro events which basically have nothing to do with the company, or maybe have something to do with the company over a period of 3-6 months, which create kind of an artificial blip in the valuation of the company.
Something like a COVID, right?
COVID, for example, right?
Understood.
So, or kind of supply shock.
But I have a question here. A lot of good PMSs, I don't know if they're good or not, but like they would say that if there is a good business, then anytime you invest, you will keep growing. Why is it that? And what you are saying
I think so there is a different strategy there
Right.
as well.
What is
but
it?
fundamentally what they are saying is that so there is a price to earnings ratio which everybody understands.
जितना बिजनेस पैसा बनाता है उस पे उसको कितना वैल्यू करना चाहिए.
So उसका मार्केट कैप बाय उसका प्रॉफिट फॉर द लास्ट 12 मंथ से उसका पीई रेशियो आता है. ठीक है. अब आपका मान लो कोई कंपनी है, देयर इज अ कंपनी व्हिच हैज अ पीई ऑफ 15,
right?
15, right? Now based on whatever work everybody does, which is let's say understanding, they say that this company can grow at 20% over the course of next 3 years.
Right.
So the next ratio to look at is that PE divided by growth.
Right.
So 15 is the PE, growth is 20. Now this ratio is less than 1.
Right.
Right? So this means that the market is not valuing the business at par with its growth.
Got it.
So
Understood.
now
तो at least 20 तो होना ही चाहिए.
Exactly.
If not at premium.
So या तो 20 पे उसका मल्टीपल.
Right.
इसलिए so people like us would find let's say businesses where the PEG ratio, price to growth ratio, is less than 1.
Got it.
Or people would, for example, the peers you're talking about, they might just say, for example, if Bajaj Finance is growing at let's say 30%, it will continue to grow at 30% till perpetuity.
Right.
Right. So therefore, it is very easy to say Bajaj Finance will grow at. I am happy to put a 30-35 kind of PE multiple there.
Right.
But will that happen? Would that not happen? Which is what we have seen in Bajaj Finance, right? For example, the growth and the earnings have not kept in pace.
Got it. That's
So-
why it just dropped. Right?
Exactly. So, for example, Asian Paints, which is I think the easier example, Asian Paints used to trade at a multiple of 100 times.
Right.
Because everybody thought कि पेंट तो इंडिया में हर कोई करवाता रहेगा.
Right.
But क्या आपकी earnings 100% YOY ग्रोथ कर सकती हैं?
सही बात है.
या आपकी earnings at least 30-40% predictable rate पे ग्रो कर सकती है
Right.
उतनी large scale पे?
Right.
The answer was no. And hence you saw one shocker in terms of inflation and or let's say the paint not happening for 2-year period, demand slowdown happened, and everybody in the paint sector is now talking about कि ये तो growth कभी possible ही नहीं थी.
Okay, that ways. Okay.
Right? So
that is what is called long-term track record. Basically.
That is basically what basically means that it come back to the valuation, that it is hard work to say no to a company time and again till it hits your price point. Experience has told us that every company comes to its price point which is intrinsic fair to its valuation,
right,
once in 1 to 5 years.
Got it.
Whatever may be the externality that will just cause it basically.
Right.
And you have to be ready with your research. Say for example, for Warren Buffett, it is very easily said that he was bathing in his bathtub when people called him up and he said, would you want to buy Goldman Sachs? And he said yes. And people are like, did you do analysis? The analysis was done for the last 30 years.
Got it. Understood.
Right? But Goldman was not available for his
That
price
value.
for the last 30 years.
Understood.
And people asked him, do you want to buy Beer Stearns? He said no.
Understood.
Because the analysis would have already been done for the last 30 years.
Got it. No, fair enough.
Right.
Another question. You mentioned experience, and I think in the interest of time, we would
Yeah.
just take another 5-10 minutes and ask.
Let's
you
go back to those questions. I think
Right. So one important question is you mentioned about experience. I want users to know actually your past 14-15 years experience, because I know you have worked with Elevation Capital, which is one of the best venture capital firms, and then you were handling their public fund at one point in time, and then you finally thought of starting yours,
Yes.
right, of Crescent Capital. Then my view and my question to you is, what is your long-term goal with Crescent Capital, and a bit about your experience in the past 14 years with, let's say, Elevation Capital, a bit of that, and then when you started and till today.
See, I think what Elevation and the private equity style of investing, even before I was working with AIF Capital before that, taught basically us was that serious investing is actually contrary to what mutual funds and other basically teach you as. They ask you to diversify. Serious investing wants you to focus on a fewer set of companies, put more eggs in the same basket, fewer eggs, and do your job well. Keep on investing like an SIP in those companies in good bad times.
Right.
Not be afraid to invest in those companies when they are up 50% if the results are brilliant.
Right.
Invest in them if they are down 50%.
But then this is contrary to sort of
mutual funds.
No, of right price buying.
No, so for example, if the stock is up 50%, but it is still trading at a 15 times P multiple, it's still relatively cheaper, right?
Understood.
So, for example, IT companies, we started buying IT when nobody thought that IT will be in a boom in the last 2 years.
Got it.
At 8 times P, the 8 times became, after 50% earnings growth, became 12 times P, which is still cheap.
See.
We bought at 15 times P, it was still cheap. So we bought it at 18 times, it was still cheap. And then we said, fine, after 20, pause. Pause. And after 35, 40, we started selling.
Because it's at PEG ratio of that.
Exactly, right?
Understood.
So that is the concept, right?
Understood.
So the core of investing is to basically live through this painful journey.
Understood.
And then hence compound your money sustainably over 2, 5, 10 years. And I think the elevation capital experience and the experience before taught us that this is what the real juice of investing is. We multiplied capital at 30% IRR there.
30% IRR, people would mean around, you are making your money 2 times in just 2.5 years.
In 3 years, exactly.
Yeah.
And we've been doing that even in prescient, thanks to a bull cycle in the market.
I'm sure.
As well. But I think sustainably, fundamentally, we believe what we are doing, we can deliver 20 to 25% sustainable IRR. And if you compound that, I think investing is a long-term compounding experience.
I'm sure people
So you have to commit lesser mistakes. Mathematically speaking, अगर आपके पास एक स्टॉक है जो 30% ऊपर जाता है और 30% नीचे जाता है 2 साल में, तो you are still less than 1, which is less than 100% basically. But अगर आपके पास एक स्टॉक है जो कि 10% नीचे जाता है और 15% ऊपर जाता है, you are maybe more than 1 basically. Sure. So I think that is what investing is, and hence you need to have lower drawdowns, maybe lower growth than the momentum companies when the market is in an upcycle, but sustainably deliver a 15, 20, 30% whatever IRR basically your underlying assets.
Understood. And I think last question before we actually move to the final conclusion of the slide and then towards users. What is it? Why don't people invest in an SIP in mutual fund versus via PMS? Like a lot of users keep asking that.
So I think in a mutual fund, because of, I would say that what the overall burden of compliance in mutual fund is, and the way the industry is evolved, it has become kind of a diversity show.
Okay.
And therefore,
explain more.
And basically, for example, you will end up investing in 50 stocks.
Okay.
And I actually I love some of the mutual fund managers because of the track record they have, the way they pick the companies.
Right.
But just because I think there are some internal checks and controls, they are not able to allocate, let's say 5, 10, 15% capital to a name. One stock. So
I see.
So even if they have a 2x, right? My 2x's will be similar to a prolific fund manager sitting in SBI small cap. Right?
So basically the point is people like a PMS has the control of
PMS
where and what concentration.
So PMS right now is a product for savvy investors, HNIs, and hence SEBI says that you can execute whatever order of freedom. In a mutual fund, because it is a retail product, SEBI says that you cannot be basically executing this because it's a retail money
and you cannot concentrate on few of these stocks.
Yes, so they will, for example, if something goes up by 100% also in their portfolio, it is 2% allocation. It is still up by 2%, right?
Is it for PMS? Can you only invest in one stock and live by, or
I think maybe a very brave fund manager will only put money.
But can you from a regulation?
I can.
Okay, from a regulation perspective.
So I can go as much as higher, whatever, but it is not advisable.
Yeah, that's right.
So we end up, for example, investing in 15 companies. We drill down to 12, 8. 10, whatever, over through 3-year period, depending on how well something is doing and how well something is not.
Understood.
So that is the way the first thing, I think that is what PMS gives you as a investor over a mutual fund by and large. And secondly, I would also say that I think PMS is a evolving industry. PMS is an industry where you have approach and access to fund managers.
I'm sure.
Which in a case of a mutual fund, which are few thousand crore, lakh crores, there are 3 to 4 orders of separation compared to mutual fund managers.
Understood.
You may argue and say everything is in the track record, but I think when times like this, where there is high volatility, times like this, when there is high uncertainty global level, you need kind of an access to fund managers.
Right.
And hence what I have seen personally, that people, see, if you go through one of these cycles, maybe you will not be so perplexed in the next cycle, but people need assurance. People need the fund manager to explain the thesis.
Right.
Therefore, the PMSs are able to do a far more higher job of communicating their thesis,
being more transparent, because
and
the person is
accessible.
right there.
And
The person is
accessible.
right there. Yeah.
And that is what I think lot of people actually like and enjoy.
Mm-hmm.
And I think hence the industry is growing there.
I understand. So I think most of it is covered. Do you want to cover something else? And I think
let's
I
go
would
to
love
Q&A.
to open it to users.
Yeah,
right?
let's do Q&A.
Yeah, I think open to the users probably, and we'll just take one by one.
Use pay.
I hope you liked it. Yeah, just a second.
Do you want to?
We just, that's it. Pressing the apple is fine. Yes, I think Swapan Ghosh has a question. Can you please recommend top sectoral based mutual fund investment?
Okay, that I think you can.
Yeah, I think we will take it separately from mutual fund level perspective. On the other question, is there any limitations for US and Canada based NRIs to invest in PMS? Any additional documentation required? How frequently will you rebalance your portfolio? And given the rapid growth of the real estate market in India, what is suitable allocation strategy for debt, equity and real estate in an investment portfolio?
Okay, so I'll answer.
So first of all, US and Canada.
So I think so US, Canada investors, I think as long as you, I don't see any limit like up to $1 million being invested.
Yeah.
We have our investors in that order, and hence we've not seen.
So this happens in mutual funds, that way. So a lot of
Yeah.
AMCs just club it. So I
Yeah.
think, is it the same for PMS or is it's okay?
We've not seen that kind of a limitation being hit. I don't know what is the capital they wish to invest in, but
Right.
basically that I think till $1 million there is
So I think there's no limitations as
no
such.
limitation. There are more disclosures required. Typically, onboarding a NRI client in a PMS is a month-long journey,
Right.
and it requires physical paperwork. But it's kind of a constant drill. If you give your papers.
No, so for US, Canada, is it more or is it across?
It's the same across all.
Singapore, US,
Actually, there is no. The government doesn't differentiate between geography.
For a mutual fund, it does. So that's why
Yeah.
people are asking.
So for PMSs, as long as you are an NRI or an NRO bank account holder in India.
That's the similar thing for US.
So any expat basically sitting in Dubai or US or UK, Canada, that is the same. You just need to have an NRO account in India,
Got it.
a bank account, and you are good to go after that.
For US, I think FATCA is another.
So FATCA disclosure is required,
Right.
but that FATCA, there's just this disclosure form.
That's it. Okay.
But FATCA disclosure government even does now for non-US because
okay.
India has become kind of a part of a global anti-terrorist disclosure whatever
Got it.
system.
Understood.
So FATCA, is my experience, I have customers across 6-7 countries, NRE customers.
Got it.
We make everybody fill FATCA and the government enables it.
Understood. Okay. How frequently do you rebalance your portfolio?
So, since we are long only fund, I think basically if let's say, so there are 3 things which we do, which we set up as an exit condition. First is if the promoter basically turns out to be completely different from what we thought it to be, and there is a 1% chance that our analysis goes wrong essentially as well.
How frequently? But
So
Sure.
if let's say that happens, I will sell the company the next day, whatever the price may be.
right.
Either I'm a profit, whether I'm on a loss. So
Right.
that is the first level of chart.
But do you keep monitoring your companies daily?
Yes.
Daily
So we
level?
quarterly.
Quarterly
is what we analyze. Not so there are some. So that's one. Secondly, if let's say there is a externality like COVID. For example, if I'm invested in a suitcase business, luggage business, and COVID happens, and I know कि अब 2-3 साल तक तो travel नहीं होना, I am better off saying maybe my thesis worked out wrong because of a black swan event which was not in my control. I'll exit in the next maybe 1 month or 2 depending on the price. That's the second. Third thing is that if my price hits, the exit multiple hits, if I said the company will be, will exit a company at a multiple of, let's say, 35, 40, 50 times whatever trailing P. And if it hits that number, we will get out that often. Statistically speaking, we churn 1 to 2 companies out of a portfolio of 15 in a year. The balance portfolio remains the same, and but so that's the way we've seen. You would have seen. I think our capital gain statements are typically nil.
Got it.
Right. So that is the proof of the pudding that we are not selling.
Long term sustainable.
Yeah. If there is no capital gain statement, there is no churn.
Understood. Right. Given the rapid growth of the real estate market, what is suitable allocation strategy for debt, equity, and real estate? So
I don't invest in real estate. I used to. We don't invest in real estate companies as well because their return on capital is below par. If you pick up, I think all the entire real estate sector, maybe with the exception of 1 or 2 names, nobody meets the bar.
Right.
Because therefore we don't like investing in real estate. People might still think that they are.
I think he's asking more from a perspective of allocating
a personal capital allocation. I think so. I would say that depending on like your age, if you are in 30s, equities should be 70% of your allocation. The balance can be debt and real estate. If you are in your 40s, maybe it's 50-50. That is what I would believe it to be. But personally, if you just ask me, I don't invest in real estate outside the home that I own for my own self.
Okay, so that is a bit of bias because I think you have always been an equity player.
No, I used to invest in real estate earlier,
right.
But as a early beginner investor, I thought I am good to time the market,
right.
And leverage can help me exaggerate my returns. But I think over time I realized that real estate still come what may gives an IRR of 12%.
Okay.
And equities, even if you pick up the worst mutual fund in India, they are at 12%.
I see. Okay, so the worst is probably the average case of real estate.
Yes. So that has been statistically proven as well. So hence, I think over time, even before becoming a fund manager, decided it's better to put that money in mutual fund than actually build more real estate casinos.
Understood. Okay, and how much should I allocate to AIFs if I need money after 20 years?
Depending on your age, 50-60% of your capital you can put in
AIFs.
In alternate equity if you wish to. But I've not understood the question entirely. Is it the same customer or is it somebody?
Is it the same customer?
Yeah, because
different.
So okay, so
different
customer. So let me retract. Sorry. What you should do is that depending on your age, if you're in your 30s, 70% of your capital should be in equities. If you're in 40s, 60% or 50% of your capital should be in equities. Put a lion's share of that capital depending on your risk appetite in mutual funds first of all, so that you understand equities, because a lot of people don't understand the volatility of equity. So maybe अगर आपके पास 100 रुपए हैं, आपने 60 रुपए इक्विटी में डाले और 40
ये तो थोड़ा आप हाई रिस्क इन्वेस्टर की बात कर रहे हो, राइट? बहुत हाई रिस्क
नहीं, मैं टोटल इक्विटी की बात कर रहा हूँ. मैं उसमें AIF की बात नेक्स्ट लेवल पे कर रहा हूँ. मैं कह रहा हूँ आपके पास अगर 100 रुपए इन्वेस्टर पर आपके पास है तो आप उसमें से मान लीजिए 50 रखिए आप डेट में और रियल एस्टेट जो भी रखना है, 50 आप इक्विटी में रखिए. 50 जो इक्विटी आपने रखे हैं उसमें से 30 रुपए आप डालिए म्यूचुअल फंड के अंदर, जो आपको बेस्ट परफॉर्मिंग म्यूचुअल फंड लगता है. लार्ज कैप रखना है, मिड कैप रखना है, स्मॉल कैप रखना है, अपने हिसाब से आप उसमें भी एट्रीब्यूट करें.
तो जब आप म्यूचुअल फंड कह रहे हो तो इसमें पीएमएस भी इंक्लूड
नहीं, फिर बैलेंस 20 रुपीज जो आपके 100 में से हैं उसमें आप पीएमएस AIF करिए, ऑल्टरनेटिव्स करिए, दोनों ऑल्टरनेटिव्स में.
बट इफ ही नीड्स मनी फॉर आफ्टर 20 इयर्स बिकॉज़ आई थिंक ही हैज,
क्योंकि पीएमएस AIF बराबर ही है ना. AIF में लॉक इन्स होते हैं,
राइट.
पीएमएस में लॉक इन नहीं होते, बट अगर आप पीएमएस में कर रहे हो तो टिपिकली आप लॉन्ग टर्म इन्वेस्टर हो ही हो.
राइट.
तो आप पीएमएस AIF में बैलेंस 20%.
बट अगर 20 साल बाद पैसा चाहिए तो मुझे लगता है कंसीडरिंग इफ ही इज अ हाई रिस्क इन्वेस्टर
तो आप फिर 70% इक्विटी में डालिए, 30% इक्विटी में म्यूचुअल फंड रखिए और 40 रुपए आप इन दोनों में रखिए. सी हिज क्वेश्चन इज इफ आई डोंट नीड मनी देन पीएमएस एंड AIF आर द प्रोडक्ट्स. राइट. सिंपल. अगर सिंपल आंसर करो,
बिल्कुल,
दैट इज इन अ नटशेल द केस.
Any other questions? Great. I think fantastic users. I hope you liked the introduction about India. Why is India shining? What sectors? What is happening in depth? And definitely we would keep doing these kind of webinars for you to understand and aware about and get awareness about India. Anyone looking to actually invest can actually reach out to our wealth managers and probably we'll get you along with the present capital to basically invest into if you are interested, or anywhere, or anywhere else if you want to invest it, we are always there for you, as you guys know. But I hope you liked it, and we keep in touch, and we look forward to have more such webinars in future.
Thank you. Hope you liked it. Thank you. Good night.
Good night. Thank you.
देखो रहा था 80 लोग थे